All right, let's talk about the biggest story in investing right now, AI. Everyone wants in. But what if the most obvious way to play the AI boom is, well, the wrong way? We're going to dig into a really counterintuitive take on this whole AI gold rush.
I mean, you can't miss it. The market is absolutely on fire with AI enthusiasm. You have a handful of tech giants whose stock prices have just gone stratospheric, and they're pulling the entire market up with them. The hype is real, the money is pouring in, but as we're about to see, that kind of excitement can have a downside.
And this is the paradox, right here, perfectly captured by some recent research from Vanguard. They're making a fascinating case. AI is going to be amazing for the economy, a huge win for productivity. But it could actually be bad news for the stocks that are leading the charge.
So, how is that even possible, right? How can something so revolutionary, so good for business in general, be a potential trap for investors piling into the most popular stocks? That is the big question we are going to unpack.
So, here's how we're going to do it. First, we'll meet the main characters here, the so-called AI scalers. Then we'll get into the two big risks they're facing and why that might open up some surprising opportunities in places you might not expect, like boring old bonds and value stocks. And we'll finish up with a simple playbook for how you can think about all this.
Okay, so first things first. Who are we actually talking about when we say the leaders of the AI build-out? The research has a specific name for them. They're called the AI scalers, and you know exactly who they are. We're talking about the titans, Google, Microsoft, Amazon, NVIDIA. These are the companies that are literally building the foundation for the entire AI revolution. All the data centers, the super powerful chips, the cloud services, everything runs on their infrastructure.
And the amount of money they're pouring into this it's just staggering. These AI scalers are on track to spend $2.1 trillion by 2027. This isn't just some small project, it's a massive, economy-wide investment cycle.
You know, we've seen this movie before. In the 1850s, it was all about building out the railroads. In the 1990s, it was the fiber optic cables for the internet. Every so often, a new technology comes along that requires this colossal upfront investment to reshape the world. And right now, AI is that technology.
Okay, so the AI scalers are spending trillions of dollars. But here's where things get tricky. Because their stock prices are so high, it means expectations are also sky high. And that sets up a really interesting risk-reward scenario. Think about it like this. On one hand, you have the AI scalers. The market expects them to deliver incredible earnings to justify their prices. They're spending a fortune, and they're always facing the threat that some new startup will come along and disrupt them. But then you look at something like high-quality bonds. Right now, they offer solid, real returns. And they're a great diversifier, a safety net in case the AI hype train goes off the rails.
And this is the really critical point about risk. History is just littered with examples of the early pioneers of a technology getting overtaken. They call it creative destruction. And the big irony here is that the AI tools these scalers are building might be the very things that let a smaller, faster competitor come along and eat their lunch. They could become victims of their own success.
So this brings us to our first alternative investment idea. And I know, bonds. They might seem like the most boring topic in the world, especially with all the AI excitement. But the numbers suggest they could be one of the smartest plays right now.
See, for years, interest rates were basically zero, so bonds didn't pay you anything. That's changed. With inflation being stickier than expected, it looks like central banks are going to keep rates higher for longer. And what that means is that bonds are finally offering real, predictable income again, returns that can actually beat inflation.
And this is their real superpower, diversification. If the AI scalers hit a wall and the stock market tumbles, high-quality bonds are built to hold their ground. They act like a shock absorber for your portfolio. So it's a solid return on its own, and it's insurance against the hype.
Okay, so if bonds are the safe defensive move, what about an offensive play that isn't quite so risky? Well, that's where value stocks come in. They give you a way to tap into the AI revolution without having to pay those nosebleed prices for the tech leaders.
This is the key distinction. The AI scalers are the ones building the AI. Value stocks are the ones adopting the AI. Think about companies in manufacturing, finance, healthcare, you name it. They can take these new AI tools and use them to cut costs, become more efficient, and create better products. They get the benefits of AI for their bottom line without the trillion-dollar price tag. This is the real widespread payoff.
And look, if you were investing back in the late 90s, this whole story probably sounds really familiar. Everyone was obsessed with the companies building the internet. But after the dot-com crash, who were the biggest winners? It was often the established companies that used the internet to transform their business. History doesn't repeat, but it often rhymes. The benefits are likely to spread from the builders to the users.
Okay, we've gone through a lot. Let's tie it all together. How can you take these ideas and turn them into a simple, clear way to think about your own investment strategy in this age of AI?
I think the best way to frame this is to imagine the AI boom like a classic 19th century gold rush. There's more than one way to make money in a gold rush. In fact, there are 3 very different roles you can play as an investor. First, you can be the gold miner. That's like betting on the AI scalers. You could strike it rich, absolutely, but you could also dig and find nothing and go completely bust. It's high risk, high reward. Option 2, you can be the shovel seller. This is like owning value stocks. You sell the picks and shovels to all the miners. You don't care who strikes gold because you're profiting from the overall activity. It's a much steadier business. And finally, you can be the town bank. That's your bonds. You're providing the safe, stable financial backbone for the entire operation. It is the safe haven play.
So let's wrap it up. The AI boom is definitely real, but just betting on the gold miners, the big tech leaders, is a very risky game. They're under intense pressure, and history tells us they could get disrupted. Meanwhile, the town bank, your high-quality bonds, is offering solid returns and portfolio protection, and the shovel sellers, value stocks, are set up to be the quiet, broad-based winners as AI productivity spreads through the whole economy.
And that really leaves you with one final question to ask yourself. When you look at your own strategy, are you betting on the frantic, risky, initial AI build-out? Or are you positioning yourself for the long-term, widespread AI payoff? That's really the key to think about. Thanks so much for joining me.